Heads I win a lot, tails I don't lose much. Those famous words which I told you about on Tuesday were memorably put together by Mohnish Pabrai, one of the world's most respected and followed value investors. Mohnish is also a well-recognized author, businessman and philanthropist. Indeed, some of the people who have benefited from his Dakshina foundations are here with us today. Here is an astonishing piece of information about Mohnish Foundation, which I'm sure has made Mohnish a very happy man. Since inception in 2007, IITs have accepted 631 Dakshina scholars out of a total of 1288. That's a hit rate of 49%. And the success rate for the IIT entrance exam in 2014 was an astonishing 64%. This is the fourth time Mohnish is coming to MDI. In the past, he has enthralled your seniors with his words of wisdom. Today, he has plans to do that to you. With darts, no less. As you know, Mohnish has been investing in India recently, so don't forget to ask him about that. I'm sure you'll enjoy his talk. Ladies and gentlemen, I'll give you Mohnish Pabrai.
Well, it's a pleasure to be here with you today, and MDI is a very unique and unusual place. There are very few places on the planet which are enlightened enough to have a value investing program. In fact, I think in North America, there's just 2 or 3 places you can actually go through an MBA program that focuses on it and does a good job. And I'm not aware of any in India other than MDI. The accolades go to Sanjay for putting it together. So give him a round of applause. So it's a field that, generally speaking, in MBA programs does not get. There are certain areas of business that don't get studied much in business schools, and one of the reasons they don't get studied much is because there are no sponsors. So for example, the whole area of entrepreneurship, early stage businesses, does not get much study in business schools. Because GM is not going to ask a study to be done on early stage businesses and such. And value investing is like that, in the sense that it's such a small niche activity. Typically doesn't have large corporate sponsors and so on. So naturally, professors and business schools tend not to focus on it. And so from that vantage point, I think MDI has done a great job, and it's great to be here, and happy to be invited back. So what I wanted to do today is I just wanted to start by going over what I would call cloning 101, and just a few perspectives of what just my own evidence and empirical experience has been over the years. I started Pabrai Funds about 15 and a half years ago. And Pabrai Funds is a clone model. Basically I lifted the template of what it does from the Buffett partnerships. And there's a peculiarity in humans where they don't like to copy what I think is obviously good. And so the Buffett partnerships were the most successful investment partnerships in the history of investing and such. And when Warren Buffett finished the partnership in 1969, when he terminated it, and when I started Pabrai Funds in 1999, 30-year period, I could not find a single example of a case where the very large hedge fund industry had cloned that model. And I found it was tremendously valuable for me that had actually happened, where it was not the way most money is run. And things like no management fees, basically focusing on long-term return, bringing in a set of investors that are with you for the long haul, and few bets, big bets, infrequent bets, all of those sort of approaches to investing. And so obviously that was a significant advantage for me and for Pabrai funds. And then a few years back in 2006, 2007, my wife and I had started the Dakshina Foundation. And Dakshina also got most of its core philosophy from Warren and Charlie. And again, in the non-profit world and in the world of philanthropy and such, I found that their ideas were very powerful. But when I look at the number of non-profits and NGOs who follow what I consider the laws of philanthropy, it is even rarer, very, very rare compared to value investing. I would say you would have a huge army of value investors compared to the number of people on the philanthropic side who actually, from my vantage point, do things the way they ought to be done. So Dakshina took these very core, I would say, principles from Warren and Charlie. So the first of these principles, just to kind of quickly go through it, none of these are, like I said, none of these are new ideas. None of them are my ideas. I simply lifted them. So when we are trying to deal with issues, societal problems, poverty, illiteracy, healthcare, environment, education, and so on, these are very tough problems to solve. And lots of very smart people, lots of very dedicated government officials, and over many decades have spent billions and billions of dollars on these areas, and they haven't been able to crack these problems because they're not easy problems, they're tough problems. And so if you're going to go at these problems, what Warren and Charlie say is that you should very seriously narrow your focus. So if you would run a portfolio, for example, 8 or 10 stocks on the philanthropic side, you should put all your energies in one or two very narrowly defined columns, so extreme concentration. The second principle is go high risk. So again, when we are trying to do investing, we focus very heavily on risk minimization. In fact, value investing works because we get a free lunch. Typically are taking low risk and typically are getting higher returns versus the risk you're taking. In philanthropy, when you're trying to go against these problems, you need to be very bold and you need to be willing to completely fail. So if you're not willing to take an approach which says that I'm willing to completely fail at what I'm doing, then it's very hard to change the trajectory of mankind. To actually get meaningful change is hard. It's as it is, these areas are hard, but if you're trying to be conservative and want to be careful and so on, so you should be willing to lose it all, in effect. And another principle that came from Charlie Munger is that his perspective is that when you have endowments in foundations, they ought to be extremely concentrated. In fact, he doesn't see a problem with a foundation or endowment having 90% of assets in one stock, for example. And the reason Charlie says to do that is that anyway when you embark on these initiatives, you are taking very high risk. So anyway, your kind of pot of cash would vaporize and be gone. So what you want to do, which is the complete opposite of investing, is you want to pursue moonshots. And if you go with 90% of assets, single stock, you would put all of that in your best idea. And the odds are high that you would get good returns out of that idea versus your 14th best idea. And then to the extent that those ideas work, you can bring all that to bear on the problem they're trying to solve. So Dakshina embraced all these principles. In fact, our assets are invested in a very concentrated manner. Usually, probably no more than 3 or 4 stocks, and we've had many times, close to 90% in a single position. And when I started Dakshina, and again I was clueless about what to do and how to do and how to go about it, I assumed that for at least 10 years, whatever we would spend and have in terms of different initiatives would lead to failure. So I assumed that 10 years or 15 years would just be wiped out in terms of money spent and not much return coming out. And with the assumption of the 10 or 15 years that would happen, I wanted to start early so that I had runway and I had time. And so what we did is, my wife and I, when our net worth crossed 50 million, we said, okay, what we'll do is we'll give away 2% of our net worth every year. And the 2% would give us at least $1 million a year. And the $1 million we treated as kind of experimental money. And we didn't have any concern if whatever we were trying to spend it on basically vaporized and didn't work, or we got cheated out of it, or whatever else happened. So we were very willing to, but our hope was that was kind of the tuition bill that we would pay, and as part of the tuition bill we would learn, and then we would over time get better, and hopefully in 10 or 12 years we would figure out what we were doing and could take it from there. So that was kind of the idea behind, and with this 2% model, the good news was we felt that even if one year we completely failed at everything we did, next year again we would have some money to play with, and the third year we would again have some money. So it gave us some kind of staying power to go and do this. And even that 2% model was copied from Buffett when he set up his 5% a year going to the Gates Foundation. It's 5% of the balance basically. So if he lived forever, it would his tens of millions would stay forever actually. So these were some of the principles, that none of these were, like I said, my idea or Marina's idea. They were all cloned, and we lucked out in a significant way because we got traction. Instead of getting traction in 15 years or 10 years, we got traction in like 12 weeks. So it was very fast in terms of it helps to have tailwinds, and it's worked out very well. And of course there are challenges, but it's worked out fine. So again, I found that on the philanthropic side, Dakshina looked so good because I am not aware of hardly any philanthropic or charitable endeavors unless there are some of them which are like, if you look at people like Zuckerberg, or you look at Pierre Omidyar and these first generation guys who are going into philanthropy, they have taken a similar approach. They're willing to fail, they're willing to make big bets and so on. But if you look at the established foundations in the US, like the Ford Foundation, Rockefeller Foundation and so on, they take a very sedate approach. Basically, the approach taken is one where it's about preservation of their own jobs and preservation of their capital, and not trying to rock the boat and having 15 different initiatives and all of that stuff. So that gives us, I think we don't compete with them, but I think that if you were benchmarking, I think Dakshina would come out looking quite good because of all of those attributes, and again, all cloned attributes. And then, if you look at my most recent venture, which is Dhando Holdings, and I set up Dhando about a year ago, or 14 months ago. And the idea was that Pabrai funds could only invest in public equities. And an insurance company, property casualty insurance company, which was privately held, had crossed my radar, and it looked like there was a possibility that they may be up for sale and we might be able to buy it. But I couldn't buy it within Pabrai funds because our mandate is only to buy stocks. And I've always had an interest in having ownership and control of one or more insurance companies, and then basically, and not just insurance. I wanted to look at other private assets because I think it was just going to broaden out the kinds of things we could do with it, and where we could take it, and how we could run it and such. And so I set up Thando Holdings, like I said, about a year ago, and then we raised about 150 million first quarter of this year, and then we reached an agreement to buy the insurance company. And I just yesterday got an email. We finally got all the regulatory approvals. So it's a company called Stone Trust Insurance. It's in Louisiana, and they do about 70 million a year in mostly workers' comp premiums. And it's a very nice company. They're extremely good at the underwriting, but they don't have much strong prowess on investing. And insurance is highly regulated, so we cannot, in fact, we cannot invest. I would say Dakshina is the extreme end of how investing gets done. I think on the insurance side, it will be very diversified and lots of fixed income and so on. But we still can have equity exposure and all that. So I think that the only change Thando is making to that business is that I will manage the float and capital, and they'll continue running the business the way they run it. In fact, we've added 30 billion of capital to the business, so it gives them some firepower to grow and such. And so again, when you look at Thando, what struck me, I was actually surprised at this because I didn't realize it until a few months back. So I certainly didn't realize it would be set up. Thando is in the United States. There are about 3,000 property casualty insurance companies, and about 550 billion a year in premiums that come in to those 3,000 companies. And when you look at Berkshire Hathaway, it's a 50-year-old model, extremely well-known model, and I thought most insurance companies would have a very strong understanding of that model. But I found many insurance companies, I would say hundreds of them that I've found so far, where there is very strong discipline on the underwriting and the operations of the insurance company, very well run, and cluelessness on the investing side. Absolutely no idea what to do. And first, I was very surprised. I found it remarkable that when you have these proven models out there, and these are large businesses, why they wouldn't emulate that model. And then I remembered, oh yeah, the world is very bad at cloning, and so they can't emulate the model even if you hit them over the head with a 2F. But then it dawned on me that the insurance business is very peculiar in the sense that if you were to actually try to replicate the Berkshire model in an insurance company, what you would need is, in the leadership of that company, you would need two very different skills. You would need strong insurance operations skills, and you would need strong investment skills. And typically the type of person who would be good at one or the other is typically not going to be the same person. And so typically these companies have come from the insurance side, they've got strength on the insurance side, they haven't really thought about it from the investment angle. And if they were to, I would say, let's say, beef up or improve the investment side, what they would need to do is they would need to follow the approach that Berkshire did with GEICO, which is they would need to identify a talented investment manager like Lou Simpson. Then they would have to bring someone like Lou Simpson on board, and then they'd have to leave him alone, he or she alone, for a long time. Because in the investment business, you can have 5, 10, 15 years before you really figure out whether a person is truly doing better than most of the crowd and so on. And so insurance is a very institutional business. And so what you would need to do is you would need to have a very non-institutional approach, which is you couldn't have a team. You would need to have a guy. Because the moment you go to a team, then you get to standard kind of institutional approaches to investing, which will get you an average result at best. And so if you want to do better than average, then you'd have to bring in a talented manager and leave that manager alone. And so you need 2 skills to be able to do that. The first skill is you need the ability to identify and hire such a person. And that is an extremely rare skill. And I never realized this. Obviously someone like Warren Buffett is very talented at doing that. He's never made a mistake on that front. He's had Lou Simpson and Todd Bloom, the Ted Rector, and everything. All of them are superstars. So most insurance company CEOs and boards would not be able to recognize a Lou Simpson if you were standing right in front of them. So they have no ability to do that. And then the second piece you need is you'd have to leave the person alone. So full carte blanche with no second guessing of their decision. So Warren Buffett said that every month he used to get reports of all the trades that Lou Simpson had done and what his portfolio looked like. And he said every month when he got the report, he disagreed with like 90% of what he saw on the report. So he did not agree with what Lou was doing. But he never once picked up the phone and told Lou what he thought about his useless picks. And so he just bit his tongue and said, okay, I have a guy who's doing his job and I'll let him keep doing his job. And that skill probably is even rarer than the skill to hire someone like Lou Simpson in the first place. And so these things started to become, these obviously seem obvious now, but I didn't actually realize it about a year ago. I realized it a few months ago. And so I think for Dhando it is a significant advantage if we can. So when I set up Dhando, I thought we would be interested in a wide range of private assets and different types of assets. You can kind of go anywhere. But my perspective now is I'd like to hone in on insurance. And I want to hone in on insurance because there is clearly a void, significant void. And I wouldn't have expected in 2014 or 2015 that we would have such a large number of these wonderful float generating machines that have that void. And some of the folks I've talked to, I would be delighted to partner with, and I hope we can consummate some more deals in the next few years. And so I'm excited about that. But again, what I wanted to just kind of highlight is that when you look at kind of all 3 of these models, Pabrai funds and Lakshana and Dhando, there is no original thought in any of it. They are all basically looking at well-accepted ideas that exist and just basically cloning them. And I think that works out pretty well. So we'll shift gears a little bit. And so this is a shot of a farm in Iowa. And I think they're just getting ready to lay down corn or soybean. And this is a graph of the average value of Iowa farmland per acre. And so these are real prices. The prices are a little bit different from Gurgaon farmland. And so for example, if in 2013 you want an acre of fertile Iowa farmland, it will set you back less than $9,000. And how much is an acre here in Gurgaon, Sanjay? $1 million. Do we have more than $1 million? So we're looking at what 100 to 1. So there's a significant price difference. Anyway, so when you look at this chart, you can see that we've had long periods where there hasn't been much movement, and we've also seen that you could have bought farmland, for example, in 1980 at about 2,100 or 2,150 an acre, and you could have gone like 25 years and still been at 2,150, and it's not even inflation adjusted. This is just normal price per acre. So when you look at this Iowa farmland, I just want to show you a couple more numbers. So this is the previous chart was going over a long period. So this is like 1981 to 2013, and you can again see the value per acre, and it's it's a pretty set thing. And I'm not showing over here daily values or monthly values, but basically, so these are real transactions between what I would call an intelligent buyer and an intelligent seller. So if a person is looking to buy farmland in Iowa, typically the only reason they're buying it is because they want to do corn or soybean farming. They really have nothing else that you could do with that land and such. And it's very fertile land, and they've got different prices for the level of fertility, but this is an average. And so some of the things that go through the buyer's head would be, okay, the amount of money I'm going to make out of this transaction when I buy, a few hundred acres, a few thousand acres of Iowa farmland, is what is the expected price of corn over the next, let's say, 10 or 20 years? What is the expected price of labor? What is the expected price of, capex and things that you have to do? And, fertilizer and other things that you have to buy. And so they have to basically try to have some view on these various aspects, and also they have to have some view on weather and the dynamics of whether they're off, and how many times in the next 10 or 20 years you would have significant destruction of crop or significant bumper crops because of weather. And based on all of that, then they would come up with an assessment of what they could afford to pay for the land. And when the intelligent buyer and the intelligent seller reach an agreement, then we get this table that you see. And this is basically showing you can ignore the 3 or 4 columns on the right, but if you look at the columns on the left, so this is the rental rates per acre. So you could buy farmland, but you can also rent farmland, right? And so if you look at the rental rates, last few years it's like from $200 to $250 per acre per year. And again, the rental calculus is a little bit easier because you don't have to go out 10 or 15 years. You can just have a view of what are the different factors of production looking like for the next 12 months. And then again, based on that, you would figure out whether the rent makes sense or not. And so most asset classes that we deal with in terms of real assets being sold between people, and especially when we're talking about productive assets, tend to be a lot of kind of detailed, smart analysis that goes on with the buyer and with the seller. And when both sides come to some kind of semblance of agreement, you have a deal, right? And you can look at that, that same kind of calculus will go on when there's a used Maruti for sale, for example. So So if you have a 5-year-old Model 3 you're trying to sell, you would have a sense of what its values are, and you'd be willing to sell it at a certain price range, and the buyer will also have a certain perspective, and then when there's an agreement, there's a deal. So these are all negotiated transactions between an intelligent buyer and an intelligent seller. The stock market is completely different from that. And it's a unique creation that's a few hundred years old. Not even, most of it is like in the last couple of hundred years. And it has dynamics which are very different from Iowa farmland. And those dynamics can work in your favor if you let it work in your favor. And of course, can work against you if you want to not appreciate kind of what the power of that model is. And so when we look at stock prices, it is not a negotiated transaction between an intelligent buyer and an intelligent seller. These are for the most part faceless transactions. You're not even face to face with the seller, for example, and they are based on some part of it is based on fundamentals, but some part of it is based on emotions and either euphoria or having a lot of concerns, and so a lot of things get manifested into stock markets. And because of all those additional auction-driven markets, which is what stock market is, auction-driven markets have a whole different dynamic than negotiated transactions. And so these auction-driven markets will tend to produce lots of bizarre behavior in terms of market price movement. And as value investors, we can take advantage of some of that bizarreness. So that dartboard that you're looking at has a bunch of numbers in it, right? And it has every ticker on the Bombay Stock Exchange and the National Stock Exchange.
500355.
All right, and let's look at a 5-year chart on this. So Rallis India, anyone heard of it? Yes. What do they do? Fertilizer is a good company. Do you own it? No. Anyone own it? And is it a value buy?
Not now.
And how long have you owned it? 3 years. And 3 साल में क्या हुआ इसको? Why did it go down in 2011? Was there a split or something? What happened there? Okay, so the stock split. Okay. Oh, 5-2. Okay, that's fine. So basically, so let's look at a 1-year chart on it. Yeah, so if you look at it on a 1-year basis, again you're seeing like 150 rupees to 254 rupees. So almost what 60-70% low to high movement. And again, what I'm just trying to highlight here is that the movement you're seeing here on this stock, for example, is quite different from what we saw on the Iowa farmland. Right? I mean, you're seeing a lot more movement. And again, if this fertilizer company were a private company, right? And if the Tata Group put it up for sale, for example, and every month they got a bid on what people are willing to buy it for, the chart wouldn't look like this. I mean, those bids wouldn't change that much month to month. Okay, so next dart thrower.
500106. 500106.
Okay, so this is a real business, right? Okay, so what does IFCI do?
Infrastructure
Finance.
finance.
Finance company? What kind of finance? Pardon? Okay, it's a good company?
Yeah.
Right? Bekar hai. Anyone own it? You own? How long have you owned it?
Like 2.5 years.
And has it done well? Let's. It doesn't look like it's done well.
It's done a lot of swings.
So are you up?
Yeah,
What was your buy price?
28.
28, and there's no splits or anything.
Nothing.
So about 20%
Yeah.
in how much time?
2 years.
2 years? आप खुश हो?
I got to exit some at 45. So.
Pardon?
I got to sell some at 45.
Okay, all right, that's good. Okay, so again, if you look at there's a pretty wide swing on this, right? So if you look at it, even 52 weeks, it's like more than 100% almost, right? More than 100% movement. And so why do you think we see the movement of the stock the way it's moving, going up and down?
There's been a lot of, other than the standard craziness, there's been a lot of problem with the upper management, internal fights and things like that.
Okay. We again have like 100% range in the last. Anyone own this? No? Okay, so we could keep doing this all day long, but thank you, Ashish. So what I just wanted to illustrate to you is that you can see that there's a pretty wide range no matter what stock we look at, even in as short a period as 12 months. And one of the things that in general is likely to happen when you are a value investor is you're likely to make these investments on the lower end of that range. I mean, you don't know what the 52-week will be in the next 52 weeks, but because you're looking at so many stocks and you're trying to pick the ones that are in one way or another from some metric undervalued, you're likely to catch it on the lower end of that swing range. And so one of the advantages you do gain is just the typical kind of exaggerated volatility that you see in stocks because of the nature of the auction-driven markets gives you an advantage. You might see a 30, 40, 50%, 70%, 100% range on the stock over a year or two, just based on the gyrations and emotions of people who are market players, and that gives you an added advantage, right? So we didn't even look at stocks that are undervalued. We just looked at a random set of stocks, and so when you actually overlay and look at undervalued situations, so one of the things which all of you I think do as a natural exercise is when you actually look at a stock and you actually studied it and such, one of the pieces you look at is that where is it in terms of its recent price history, and you generally will feel better about buying it, especially if you're a value investor, if it's on the lower end of that at least recent price history, and so that gives you some advantage, and it is one more, I would say, small advantage in your arsenal in terms of superior returns. And I have seen that in my own portfolio many times where I have actually, in hindsight, been wrong on the stock, but made decent gains on it. And simply because I happened to buy it at one of those low points, and just the natural kind of ebb and flow of the stock sometimes got me 50-60% by the time we exited, and I'm perfectly happy with if you give me 50-60% every couple of years on these things, that's no problem. We'll take that all day long. So with that, what I'd like to do is if we could maybe open it up to questions, and that is always the more interesting thing for me, is to learn about what's on your mind and what you'd like to talk about, so we can take it from there. So, and if you could just introduce yourself, and if you're a student or where you're from, that'd be great. So go ahead.
my first question is, a lot of people teach us how to buy. I would like to know your philosophy on how to sell, or when do you sell, you know?
Right.
Because from childhood we've been taught to buy things in the shop. We've never been told to go and sell something. So it's very difficult. And the second question is that very few people are lucky to have the float of an insurance company like you and Mr. Buffett have. And in India, a lot of capital misallocations keep happening at the promoter's end, which does not permit you to own a stock forever kind, you know. Like buy and hold strategy that Mr. Buffett always tells us to do. So there's always this challenge in our minds whether we have to always look at it in that sense. Would you still say in the Indian context that buy and hold is the right strategy, or you have to keep churning for the cash flows and for other compulsions of the market?
Sure, those are great questions. Well, I would say that selling is more difficult than buying. You know, it's usually easy to get into things. It's a little harder to get out. Just a few things that I do is that, and these are just, I think most of this will be naturally obvious to all of you, or most of you, is that you know, if you are operating within your circle of competence, then you understand the business, and if you understand the business, you understand what it's worth, and you would have a good idea. So if a stock is trading at 50 rupees and has a market cap of 200 crores, and you understand the business and you think it's worth 500 crores, then you know it's a set of metrics you have very clearly in your head. Then I usually write up about a paragraph of what my perspective is on the stock and what I think the intrinsic value is and why I think it's worth that, and usually in very simple English terms. And that I do that before I buy, and usually I'm looking to sell at about 90% of what I think is perceived intrinsic value. And usually I'll go back every 3 months or 6 months and update my thoughts and perspectives, because the company may have had some developments, and at least once you get past a year or multiple years, intrinsic value may have changed, and hopefully it has increased, and then you know you can accordingly update intrinsic value and accordingly update what you think the sell price should be. And so it's it gets down to the basics of Graham, which is you're not buying a stock, you're buying a business. So some basic things just to keep in mind, that you always approach it from the perspective as if you're buying the entire business. You know, so if Apple has a market cap of 700 billion, you know, the question to ask yourself is that if your family had 1.5 trillion in wealth, for example, would you be willing to buy the entire company Apple at 700 billion? And if the answer is yes, then invest in the stock. And if the answer is no, then you shouldn't even buy $100 worth of Apple stock. So the mindset of looking at it as an asset versus a stock is important. If you understand what the intrinsic value is, then you're also there. And of course, there are mistakes in investing, and you know, mistakes actually are quite numerous even amongst great investors. And so, whenever it is obvious to you that you have made a mistake, then you can reevaluate. One of the things I use as a circuit breaker for myself, just to make sure that I'm not kind of trigger happy, is usually we tend to get self-doubt about a stock, especially when it declines in price after we buy it. And my own history is most things I buy, they know I've bought the stock and they proceed to decline immediately after I bought. Has that ever happened to you? Okay, just you and me, nobody else. And so what I do is that to counter any urges to take instruction from Mr. Market on value is I just use a rule where I'm unwilling to sell a stock at a loss until at least 2 years have passed from the time I bought it, and present intrinsic value has to be below present stock price. So it has to be very clear the present intrinsic value is below present stock price, and a significant amount of time has passed, so that you kind of shaken out any kind of market driven psychology that may be driving you. And well, the second part is that which is buy and hold versus trade in and out is I think a market like India is a market where there is the possibility of having very long runways. There's a possibility of finding relatively small businesses that have long runways, high returns on capital, good management, and have tailwinds. And the very best investments would be not investments that are cheap from a quantitative perspective, but ones that have those types of dynamics. There's a runways to business could be worth 10 or 20 or 30 times in revenue in 5 or 10 years, and such. So I think that if I were in India, that would be my primary focus, is to try to find. And I think the markets here are very different from US markets in the sense that it to some extent it becomes very heavily like PE, private equity investment. You have to do a lot more work in terms of understanding the nature of management and ownership and so on. But to the extent that you can identify those long runway opportunities, and you can identify them at prices that are quite reasonable, then I think that's the way to go. The buying and selling is also perfectly fine, but I would say do it within the context of that you own the business and you think of it as owning a business versus owning a stock, and look at whether you're buying and selling the entire business and whether the price at which you're buying and the price that you're selling is a rational decision both ways. So that's my 2 cents on it. Other questions? Yeah.
Hello sir, Kaushik Nahani as owner. One of the things that you picked up from the Buffett partnership was single person team as far as investments are concerned. Don't you think having a devil's advocate sort of helps in certain situations?
Yeah, that's a great question, and I had a conversation a few years back with Charlie Munger, and he mentioned that he just casually mentioned that he always had someone to talk to about investments. So I said, "Oh, you mean like Mr. Buffett?" He said, "Well, it wasn't always Warren, but I've always had someone to talk to." And in fact, recently he said that, I think at the Daily Journal meeting, he said that even Einstein needed someone to talk to. And so I think that there is each human brain processes the same information differently. And to the extent that you can find someone who's thoughtful and is not processing data similar to you, it would be useful to have those conversations. But I think that is different from having a team. So if you have let's say analysts under you and they report to you, then the incentives and the dynamics of that exchange are very different from having a peer where there is no vested interest of any kind and two people having conversations about stocks. So I never appreciated, I think for most of the history of Pabrai funds, I operated making decisions on my own. And I have a good friend, Guy Spear, and usually he and I will talk about things that either he's looking at or I'm looking at. And many times we don't agree. And many times I'll buy things that he won't buy, or he'll buy things that I don't buy, and so on. So if you look at our portfolios, they look very different from each other. But I have found it very useful to have those conversations, because actually Guy runs the fund on his own. Neither of us has any economic interest in the other fund. We don't gain or lose anything by what happens. And I'm confident that he's confident that we are candid in sharing our beliefs and perspectives, and that's useful. So I think that it is valuable to have that type of a relationship, and it doesn't need to be an off the chart person. I think just having someone else. One of the things that happened just this year actually in Omaha is I was at this brunch, and Charlie Munger was there, and he was sitting there and there was nobody next to him, so I decided to help the guy out and give him some company, and just so he doesn't get bored. And I took Guy with me, and I said, Charlie, this is the person I talk to about my investments. And Charlie immediately got very interested in, he's kind of checking Guy out. And then Guy says to him that, I don't know why Mohnish cares to talk to me, because I really have nothing to add to anything he usually comes up with. And so Charlie said that, well, the process of going through a process of talking to someone else about your ideas requires you to put them together in a certain kind of format and manner that can be articulated to the other person. And that process is useful in seeing some flaws in your own argument. And so then Guy said to Charlie that, Mohnish could actually just do that with a monkey. He could just articulate. So Charlie immediately said, yes, but the problem is Mohnish would know it's a monkey. And so it wouldn't work. So Charlie actually, I saw in that interaction that, and I've seen even when I've talked to him, is that he puts a huge amount of weight on that notion of having another person to bounce things off of. And so I actually don't move on anything now, and I haven't moved on anything until I have that at least one conversation, and then from there we have many conversations. And like I said, we may not agree, but exactly what Charlie said, it forces me to kind of put my thoughts in a organized manner and hear some perspectives may be different and such. So it's a huge advantage to do that. But I think you have to set it up in a more manner where there is no vested interest, there's no axe to grind. It's a trusted, open relationship, and then that works. Yeah.
Management funds. So we hear a lot of time market wizards in India saying that they're holding on to blue chips like ITC, Honda, just because their historical cost, they get more dividends than the historical cost of this thing. So in terms of relevance of historical cost and margin safety, is it a positive bias which allows you to hold on to such blue chips, or is there an element of survivorship bias here?
Well, that's a good question. I mean, I would say that, please have a seat. Yeah, so, if you have held a company like, now it's Hero Motors, right? It's changed. Pardon?
Motor Corp.
Oh, it's called Hero Motor Corp. Okay, so if you held, let's say, for 20 years or something, what would be your return on that? Like, what would be the...
More than 4,000.
Okay, so like 45x, 50x or something.
Excluding all the dividends, the way they
Okay, 100x maybe. Yeah, so obviously the thing is that one of the things that happens in terms of human psychology is that if I've owned something and I just told you you should look for long runways, right? And if you look at a company like Hero, there are so many advantages. Motorcycles are better in rural areas than scooters are, and they have all the distribution network. They've got this huge install base. They've got all the brand equity and all that. So for someone else to uproot that is not easy, right? So there are all these positives, but capitalism is ruthless. It's the nature of capitalism to be people aspiring to take your moats away and such. And I think that if a person is holding on to Hero Honda because of the past, that may not be as robust as holding on to it because of having some view of the future. So the future has a way of unfolding differently from the past. So if you are able to, if you understand the business within your circle of competence, then you can look out 5, 10, 15 years from now and see that those aspects of the moat are going to be intact, and what the valuation of the business would be. So again, what is the Hero MotoCorp's market cap? Would you know?
20,000.
Pardon? 60,000 crores?
10 billion.
Okay. 10 billion. That's it. So the question I would ask, if someone is buying the stock today, is that, how does it get to 120,000 crores? And how long does that take? Or how long does it take to get to 200 crores, 200,000 crores? And how long does that take? And what are the circumstances? And does the company need to do heroics to get there? Or it's just, it's going to get there because of all these natural tailwinds? And but I would say, holding on to it because, the dividend is more than the cost base, I think that is irrelevant. The cost base is irrelevant. I think the thing is that you look at it as if there are advantages. Of course, in India you don't have the same dynamic, but in the US we have significant tax issues. Long-term gains, yeah, so that you have no tax implications. And that's a beautiful place to be. And and so I think that if you have a view that this is a business that is going to double, triple, quadruple in value in the next 5 or 10 years, it's a great place to be, and should be there. And if you have a view that for whatever reason that may not be the case, or the odds are low, then you have to look at something else. But I would say just identifying those long runways and being, I would say, non-emotional about how you go about looking at them long term is a good way to go about it. Yeah.
Well, I have one question for you. It's regarding your recent investments in some of the banking stocks in India, J&K Bank and South Indian Bank. What is the rationale behind these two investments? Is it just because India is largely an unbanked country where there is a lot of scope for the next 10, 20, 30 years? Is it just this one, and also with respect to the valuations, it appears to be cheap compared to the other stocks in this whole program? That's one question. And the other one is, don't you think there are any issues with the J&K Bank with the recent Black Swan event, the big floods which have happened in Jammu and Kashmir?
Okay, good questions. But we cannot talk about our portfolio till we exit these positions. So, next few years past, when we no longer own the positions, we can talk about it. But I think the thing is that there is a, Buffett and Munger talk about the commitment with consistency bias. Obviously, if I own the stocks, I must have a favorable view of them. And when I share those favorable views of them in public, when evidence comes out that doesn't support those views, I now say in my mind that, I've mentioned these things, so how can I now sell these things? It makes me look stupid. So I'd rather look stupid in private. but at some point we won't own these stocks, and when we don't own them, we can talk about it. Yeah.
I am Kanab, worked at Axis Bank at present, and I'm a individual investor by the side. So that was one question. Would you advise for somebody to wait for 5 years, 7 years, no matter how long may it be, to buy a very, say, a highly defensive business like a Unilever or a P&G or a Nestle, and then wait for 10, 20 years, whatever is the horizon? Do you think it's the right strategy for an individual investor A, B for a portfolio manager as well?
Yeah, that's a good question. And do we have any? Pardon? Yeah. Yeah. So the thing is, if you let's say have, let's say you have 1 lakh rupees. I'll put the comma the way to it be there to the US. So let's say you have 1 lakh rupees, and this is the 2014, right? And you can't find anything of interest, and you sit on it, and let's say now it's 2020, and now something shows up of interest which is deeply undervalued and long runway and all that, and you make the investment. So invest the 100,000 over here, and then this thing, let's say, is growing at 20% a year from this point on. So if you even go, let's say, 2025, so this would be like 20% would be like 3.5 years for a double, right? So let's make the math simple. Let's go to like 2027, for example. So 2027, you've gotten 2 doubles. So you are at 400,000, right? So what is the return from here to here? So 13 years. So in 13 years, if you get a 4x, what's the annualized return on that?
9%.
Pardon? 11%? Okay, I'm not calculating, but does that sound right to you? Pardon? So let's say 11%. So it is very hard to make up lost years in an investment. If you have an investment which does nothing for 5 years, nothing for 10 years, and then it starts moving at even quite an aggressive rate, it would take a long time for the annualized return to the investment over the entire period to have that rate. So to get to close to 20% on this, you'd have to go many more years, quite a while.
You're willing to wait for 20 years in the future. Hold the stock for 20 years.
Right.
So do you think it would be a good bet?
No, because I think that at least the way Buffett and Munger would do it is they look at it from the point of view of opportunity cost. And so a better way to approach it is what is the best, now I would say that with some caveat, but what is your best option today where the risk of permanent loss is low and it's the best of all the various options you have in terms of returns. You're better off doing that versus sitting there endlessly. I think sitting there endlessly. So first of all, if you're an individual investor and you're sitting in India with the thousands of stocks on the exchange, and I find it hard to believe that you couldn't come up with something that is low risk and decent return probability. And so the best way to approach it is, I think, look at what is your best options today. Now, sometimes the options are really bad, and in that case, your cash is not a problem. But planning to hold cash for some long period of time and then planning to have a runway for 20 years or something, the thing is the moats have a way of evaporating and they have a way of changing. So the thing is you're making an assumption that even a Unilever or P&G would have unaffected moats for 20 years. Whereas in the US, for example, we have seen significant erosion of a P&G moat because of the Walmart and Costco of the world. They have taken away a lot of their pricing power and so on. And so I think moats are elusive, moats can shrink, and it compounds the problem if you say I'm going to wait 10 years to get a 20-year moat. I think that's a very difficult proposition to be right for 30 years. You need to be right for 30 years. And it's kind of hard to look at businesses today and know where they'll be 20 years from now. There are very few businesses that you could actually make. I'm not even confident that a company like Hero Honda, you'd be able to make a 20-year claim. I mean, it may well work out, but that'd be a difficult thing to say that you have a steady state situation for that long. So I would say that it's probably better to look at your best options today. Yeah.
I'm finding this Rohit. I manage my own money and so external capital as well. So just related to your question about investing in India, I'm not going to specifically ask about your portfolio, but what changed your mind? Because I read somewhere a while back that you were sort of averse to investing. It's not recently, but you were some time back. So what changed your mind about investing in India?
Well, I think the Indian markets for the most part are outside my circle of competence. And the reason they are outside my circle of competence is because I'm not here. And the format the type of work I would need to do to really understand many businesses would be similar to private equity investing in the US. You really have to get to know management and get to know a lot of, I would say, you need to be on the ground and get to know a lot more, I would say, a deeper understanding of things. A few things seemed within circle of competence, a few things, and it's hard to know exactly how the future unfolds. But India has had I would say, 67-year history, more than a 67 history of, I would say, either leaders who had a socialist bent or leaders who had poor governance, or both, even when they were capitalists, they were not whole hog capitalists and so on. So we have a leader in Modi where there is a chance for very significant change. And I've always felt that in India, for example, the government, if they did just two things, two or three things. One is get out of the way. That would be the first thing. Getting out of the way would be a great thing for the government to do in many, many places. Build out great infrastructure, build out great schools. That would be a tremendous model for India. Get out of the way and focus on the things that governments are meant to do. And there's some chance that may happen, right? And so if we actually end up with those dynamics, then you could see significant GDP growth and significant growth in corporate profits and even revenues and so on. So you get a lot of tailwinds in that case. And so I think we've made a few bets where we think downside is very muted, and we think there is. Most of the bets we have are in banking in general. Banks will grow at a multiple of GDP, and so if the GDP growth is coming in, then that will help. And I'm sure India has a large population, one bank and such. I think there's lots of scope on that front. So those are some of the reasons, and we'll see how it works out. So the approach I took with Dakshina was that I'm a guy sitting in shorts in California, and I don't have much. I didn't understand a whole lot about what is involved in India and so on. What I had understood at that point with Dakshina was that I was familiar with the Super 30 model. Have both of you heard of Super 30? You know, Anand Kumar, and I'm going to see him later today. So I was familiar with Super 30. I obviously was familiar with the IIT. I was also familiar with the fact that the IIT is a strict meritocracy, where basically if you do well on the test, you get in, and it doesn't matter if you're the Prime Minister's son or Ambani's son. If you don't do well, you're not getting in. You know, it's a very clean system. And I was also aware that if you get into the IITs, there is a very high subsidy by the government. And I think I have no control over that, but I think it's a stupid policy where the government subsidizes everyone, right? So if I am Godredge's son and I can pay full fare, I have no ability to pay full fare. The government gives me the same deal as some poor farmer's son. And so, in effect, that is a misguided public policy. But that's a topic for another day. But so, I saw the Super 30 model, I saw the power of that model, I saw that the hiccup, I would say the IITs were meant to be taking the best talent of the country and producing engineers. But what had happened is it became taking the best talent amongst middle class or higher from urban areas and then producing engineers in that pool. So it ignored large portions of the population. It ignored the poor, it ignored rural, and so on. And I felt that if we are able to get kids into IIT, for a very small amount of money spent, you can actually lift a family from poverty. So for example, I'll give you a simple situation. Dakshina spends about, and I'll get to your question of what we did in the first 12 weeks, but I just want to give a context of where we're coming from. So Dakshina spends about, let's say, 1 lakh to 1.25 lakh per scholar we take on to get them prepped for IIT. And typically we are now getting about 60-70% of them in. And even the rest of them, the 30% who don't get in, are going to NITs and other schools. So almost 100% are going to engineering schools. And the 1.25 lakh that we spend, in effect, forces the government to spend like 25 to 30 lakhs on that kid. Because once he gets into IIT, that is a subsidy. 6 or 8 lakhs a year is what is costing the government. And so I'm happy to spend 1 lakh if the government spends 25 or 30 lakhs, a good number for me. But if you think about, and we are able to basically lift a family from poverty from scratch. I mean, we just had a kid who joined Dakshina in 2010. His father is a very poor tailor in a slum in outskirts of Hyderabad, making less than 4,000 rupees a month. We prepped the kid for 2 years, from 2008 to 2010. Then he took the IIT entrance exam. He got a rank of 63 out of 500,000, our best performing guy. Then he went to IIT Bombay Computer Science. He finished this year, 2014. And Google interviewed him by Skype from Mountain View, and they hired him. And then they had visa issues, so they moved him to London. I think his starting salary is 100,000 US dollars a year. First month, he moved his parents out of that place where they were living. Second month, they put a down payment on a house they're going to own. So they moved to a rental, they moved to a house now. And the third month, he's getting his father moved from working as a tailor for someone to being on his own. His own tailoring shop, right? So we are seeing, you're going from like $80 a month to $8,000 a month. And the whole thing costs $2,000, right? So there's a great model. So I knew that the model is good, but I had no understanding of how to execute the model. So what I did is, this is what happened in the first 12 weeks. I contacted some friends I knew in the US who were IIT grads, because कहते हैं ना खालिद ये ना थी हमारी किस्मत कि IIT की crack होता. So I'm not an IIT grad, but I have friends who are IIT grads, and I told them, hey, I basically want to find poor kids And there was an industry, there's an industry in India where I can pay a coaching institute in Kota 1 or 2 lakhs and they'll train them, right? So the industry is there. All I needed to do was find bright, poor kids and send them to Kota. This was the original model I had in my mind. Send them to Kota, pay room and board and everything, and then 2 years they'll take the exam and we'll see what the returns are and what the results are and all of that. And over time, we are ready to lose money for 15 years. Over time, we'll improve the model and such. So, I only had this model in mind, but I had no one in India. I wasn't going to move to India, none of that. So, I talked to some of my IIT friends and I said, look, I would like to find someone in India who can be a consultant or be a helper for me, who can help me starting to put some of these pieces together. And I've had a lot of experience with startups. And so one of my friends who's from IIT Madras, he said, okay, write up something, I'll put it on some IIT Madras alum message board. There is this NGO who wants this and that. And so I wrote up some blurb of what I wanted to do and he put it on that message board. And one person responded. So this guy was about 67 years old. He was a retired guy and he had graduated from IIT Madras. And he said that, hey, I like your cause and I'm in Bangalore and I'm idle and tell me what to do. I'll do it. So I told him, okay, here's what we'll do. I said, I want you to be a consultant. Okay, you're a consultant to Dakshina. I had already formed the foundation in the US. I said, you're a consultant. And every day you work for Dakshina, I'll pay you 5,000 rupees. Okay, and every hour you work for Dakshina, I'll pay you 800 rupees. So if you work 3 hours, you just keep track of your time and end of the month, we'll send you the money. And so he didn't really care about the money, but he said, fine, no problem. That sounds fair to me. So I said, here's the problem I want you to solve. I want you to figure out how we can find poor kids who are smart, right? And I had 1 or 2 ideas. So I said, one idea I have is that there must be kids showing up at these coaching institutes who want to get admitted but cannot pay the fees, right? So I said, and I said all expenses are paid. So if you're traveling or flying anywhere, whatever, all paid. And I got him a credit card, which was a Dakshina credit card. I said, direct bill, if you're taking a flight, whatever, you don't need to. You have no risk of an invoice being unpaid. Okay, you can just direct bill. And so he became a traveling salesman. He was going around and I said, go to Kota, meet all the coaching institutes, tell them you want to do this, ask them if they have kids that they run into, whatever. And so he started having a number of meetings with different coaching institutes saying, look, if you find people who cannot pay, we can pay, and it's helpful to you because you'll get better students and all that. And these guys listened to us, and we actually got our first scholar from Bansal classes. So we met Mr. Bansal, and the coaching institute have a short memory. So just that afternoon, some family showed up and they had no money and all that, and they were crying in front of them and all that. They said, "Please don't go." Ramesh aaya tha, usse baat karna. So Ramesh met these people and said, they seem to be very poor. The kid has qualified in the Bansal test. So, like I said, we are not concerned about risk. I said, support him. Tell him we'll pay for everything and admit him and all that. So he became our first scholar. We admitted him to Bansal classes. We got him set up in a dorm over there, and he got going. And as this guy was meeting more and more people, the name of this school system, Jawahar Navodaya Vidyalaya, started coming up in multiple conversations. Multiple people told him, you should look at JNB, and he had never heard of JNB. So when the third guy told him that, he took a note and did some research, and he found that there is a school system in India called Jawahar Navodaya Vidyalaya. Some of you might know. Are there Dakshina scholars here? And which JNB are you from? Can you say which state and district you are from? Pardon?
JNB Nadia, West Bengal.
Okay, and you?
JNB West Champaran, Bihar. JNB Durg, Chhattisgarh.
Okay, so there are 550 JNBs in the country, and they are in every district. almost every district in India. And basically, these schools are phenomenal. I mean, I would say that if you visit a JNV, you would find it hard to believe that the government of India has actually executed such a phenomenal system. The schools are fantastic. It's a magnet system, so 2 million kids, 20 lakh kids a year in 5th standard take a language and independent IQ test. And like the IITs, the testing is absolutely corruption free. And all the results get tabulated in Delhi. And they admit the top 2% of the kids. So out of 2,040,000 kids get admitted into 550 JNVs across the country. And so you have to be from that district to go to that JNV. So typically, let's say there's a district in Jaipur. आप कौन से district से Nadia? So Nadia में how many kids take the test every year in 5th standard? More than 1,000. And that's a low number. And what about you?
Nearly 8,000 to 13,000.
Okay, and which district you say you're from?
West Champaran.
Bihar. Yes. Right. Okay, so if you look at the West Champaran district, there are like, let's say 10,000 kids from that district who are taking this test in 5th standard, and they can take it in one of 14 languages, and they are only admitting 80 of those kids. Okay, so you have to be super smart to be admitted. आप smart हो ना? कौन से आप which college did you go to?
Now I am in NIT Surat.
Okay, and what about you? Okay,
IIT Bombay, I passed out last year.
where are you at now?
Bank of America.
Alright, congratulations. So basically, once we found the JNVs, once this guy found out the system, so he said, look, this system is in rural India. It's in all God-forsaken places, nowhere near any civilization. And it is only attractive for people who are in rural India who don't have that much money, or because they're not going to send. It's an integrated system, they're scheduled caste, scheduled tribe. So if you have any caste-based issues, I mean, your kid's going to be sleeping next to a scheduled tribe or scheduled caste kid. All of that is fully integrated. So it is not an attractive school system for affluent people to send their kids to. But it's a very good school system for poor people to send their kids to. And the government does a pretty decent job. The teachers are hit or miss, but you get great talent in. So once we found JNV, then what Ramesh did is, and he's on the 5,000 rupees a day on this thing, and so he went to Delhi, and we were lucky. We met two guys who were senior. One was the commissioner of the JNV system, and the other was the head of academics. We had a startup, unknown, right? I got him a business card which says Mohnish consultant, right, on Dakshina, and he said, look, we want to do this, and can we work with your school system, and can we test your kids and then find them and so on. So they listened to him, and the JNVs had a problem. The problem they had is they had all these very bright, they knew their kids were very bright, but after 12th standard there was nothing, right? The kids finished after, and they're in the middle of nowhere. I mean, if you are in West Champaran, Bihar, IIT coaching है West Champaran to Bihar में? नहीं. How far is the closest coaching center?
200 kilometers.
Okay, so there you go. So you have these, 10,000 kids, you pick the 80 kids. There is no chance, even if you had the money, to get any IIT coaches, right? So they knew that problem, and so what they said to us is, okay, we'll do an MOU with the unknown Dakshina, and we'll set up like one school in each region. There were 8 regions in India, and we'll have you test the best kids in each region, and then we'll take 40 kids in each region and move them to that one school, and Dakshina will provide the faculty and all of that to run the program. That's how we started in 2007. And we had no expertise. So by this time, about 9 or 10 weeks had passed. And in the 9 or 10 weeks, I think maybe 60,000 rupees or 80,000 rupees had been spent. In terms of, and Ramesh came to me after about 10 weeks and said, we have to bring this monthly or the daily billing to an end, because I can't keep track of the hours and all, and it's taking too much of my time. I need to go full time. So I switched him to 1 lakh a month. I said, full time, fine. You're full time. And I told him move to Kota. I still was focused on the Kota thing. So he moved with his wife to Kota. And and we got the MOU done with the JNV system. And so March of 2007, we had started Dakshina's operations. By June, we had that first scholar, and by September, we had 320 kids we had selected from the JNVs, and we had moved them to the 8 schools. And what we had done in Kota is we had signed contracts with all these coaching institutes to provide faculty at these locations. So basically my take was all of these pieces just needed check writing ability. And I knew I had check writing ability, right? I didn't have any ability beyond that, but we could write checks. And we were up and running. And then what happened is that lots of these coaching institutes did a very poor job. They sent bad faculty. They could not. What we found is that when we are doing coaching in Assam, for example, people would say, yes, I'll do all this stuff and this is the thing. They would take the money, send us invoices, and then useless faculty or incompetent faculty would show. And so what ended up happening is, like, for example, in Assam, for example, we had 40 kids, and only about, I think, 6 kids first time made it to IIT, right? But in other regions, it was a little bit better. I think first batch, 22% of that batch went to IIT. And I knew that we had seen a lot of problems to get even to 22. So I knew that if we had better faculty and better things going on, it would improve. And my take is that in any business or anything I'm running is all I care about is that the next year is better than this year. So we just started to chop some wood and go on. So we became lucky. So the first 12 weeks I found this guy, honest guy, simple guy, and he was doing his thing. We got the MOU done with the government. We got the scholars. And one of the things that works, and I'm sure, what year did you guys finish your coaching with Dakshina?
2012.
2012, what about you?
2009.
So आप 2009 में कहाँ पर coach हुए थे? Where was your center? Cuttack, right? And were there problems? Lot of problems. He is the first batch. Okay, so how many of your batchmates went to IIT?
On that year or?
Yeah, that year.
Very few, 4 or 5.
There you go. Right, so, and Cuttack had smart kids, good batch. And so what we did is we basically just then worked on the model to improve the model, because we knew the talent was there, we knew that all of the pieces were there, and then we just worked on, okay, now let's just keep improving the yields and all that and work on it. So that's, it's always better to be lucky than to be good. So I think Sanjay, we should...
I'll not waste too much of time, and I'll just ask you a simple question. How did value investing impact you in a personal level?
How did value investing impact you on a personal level?
What choices you make as a value investor that impact you personally speaking that you would have made otherwise?
Okay, well that's a good question. I might have to think about it for a second. I would say that, let me put it this way, I would say that value investing led me to Warren Buffett and Charlie Munger, and I picked up a whole bunch of values which have nothing to do with investing from these guys, right? And I saw specifically in actually both their cases that they really didn't care about the money they were making. I mean, I think it's a way of giving score for them, especially Warren. But it has very little impact on their lifestyle. They're not really spending the money, going to give it away and all those sorts of things. And so I think some of that has rubbed off on me, probably not to the extent that it's with them. So I think it grounds you. I think some of those, if you pursue value investing, you cannot pursue it without understanding Warren Buffett and Charlie Munger. If you understand them as people and as humans, they're as high a quality as you can possibly get. And if you emulate their qualities which are unrelated to investing, the only thing that can happen is it can improve your life. So I think for me personally, there would not have been, for example, there would not have been a Dakshina if I were not influenced by Warren Buffett, right? So that is not Warren Buffett, the value investor. That's Warren Buffett, the philanthropist, right? And so I wouldn't have had the values of, the fallacy of having large inheritances. My kids are not interested in large inheritances, as neither am I. And again, that has come through because of the influence of Warren and Charlie. So I think there's many things that I picked up from them that either I'd never paid attention to or I never thought about. And so that's been useful. And with that, thank you very much. It was a pleasure.
Look forward to having you again next year. It was very wonderful to have you over as always. I think the discussion on Dakshina was the most impactful, much more than the value investing part. Thank you.
Okay.